Hey guys, welcome back to the channel. It's me, Adam, and you are watching Steady Invest. With YouTube, I am getting more and more excited with every passing video because we're moving along from those mundane, basic finance kind of topics and more toward the fun stuff. So we're looking at stocks and ETFs and more about what this channel is going to be about. So super excited. What today's video is going to be about is the savings account that you don't know about. It's a savings account in the sense that it's not actually your traditional savings account where you just put a bunch of money in it and then kind of just works on its own, you get interest, whatever. It's actually a bond ETF. And in my opinion, it's the best savings account or the best place to park your Canadian cash when you don't really know what to do with it and you want to, instead of having your money in a checking account or a regular savings account where your interest rate is going to be really low, in my opinion. And just because it's my opinion, do not do it. Make sure you do your research, but in my opinion, I believe it's one of the best places to park cash in the meantime and allow it to grow, but also at a very minimal risk. So without further ado, guys, let me show you what I mean. Alright, so it's called ZST-L.TO. It's a bond ETF. It's called BMO's Ultra Short-Term Bond ETF Accumulating Units. So to give you guys a quick rundown of what it is, it's been designed to provide exposure to a diversified mix of short-term fixed income asset classes with a term to maturity of less than 1 year or reset dates within 1 year. I know that sounds a little bit gibberish, so I used simple English Wikipedia. So we haven't talked about bonds before. I don't expect to talk about them very much in the following videos because I'm just not interested in bonds. Interest rates are low right now. And I think stocks and equity is where it's at right now. But again, this is my only exception. I'll explain why in a moment. But anyway, a bond is a contract between two companies. Companies or governments issue bonds because they need to borrow large amounts of money. They issue bonds and investors buy them. Bonds have a maturity date. That means at some point, the bond issuer has to pay back the money to investors. They also have to pay the investors a little bit more than they paid for the bond originally. Bonds are usually traded through brokers and are a part of a financial instrument group called fixed income. And then actually, you know what? I'll go to this over here. So this is my drawing or my illustration. So as you can see here, BMO is the investor, and these are the companies that are issuing the bonds. So they're buying. So BMO is buying these bonds from Manulife, Scotiabank, and TD. So on day one, they give them about $2, let's say, as an example. And then within that 1 year, in less than 1 year, these bonds are going to mature, and then so let's say 6 months later, as an example, the three companies are giving back BMO the $2 that they gave them originally, and a little more as well. So I know this is a very basic example. It's only $2; they're only getting 2 cents extra. However, in reality, BMO is actually giving them millions and millions of dollars, and then Manulife, Scotiabank, and TD are returning back a little bit more than 2 cents. Back to this page. So this ETF is designed for investors looking for accumulating defensive income, invested in a diversified portfolio of federal, provincial, corporate bonds, and preferred shares. Includes bonds with less than 1 year to maturity and professionally managed by BMO Global Asset Management. And when we scroll down, we see here actually that the risk rating is low. Scrolling down, you can see their top holdings. So RBC's bonds make up 8% of it, or about 9%. Manulife 7%, CIBC, and so on and so forth. Now, why do I use this as my savings account? First of all, this graph. I have not seen another graph that looks anything remotely like this. It literally goes up in a straight line. I know it had the market crash back in March. It went down about 1%, but as you can see, guys, let's go from 2019 to 2020 roughly. It went up about 2.5%. So let's assume that it's going to keep going on in that same linear direction. If it's going up about 2.5% a year, let's say, and it goes down 1%, you're still making 1 to 1.5% for that year. Whereas if you're putting your money in a savings account in CIBC, TD, whatever bank you're with, your interest rates or the money you're getting back is going to be like 0.5%. Interest rates are at an all-time low right now, right? As well, it's also important to understand that this crash that happened with the rest of the stock market back in March was the fastest and most violent crash ever, and ZST-L went down 1.03%. So, and personally, that's a risk that I'm willing to take. This is a very low risk investment. Again, I'm using it as my savings account. Essentially, any money that I don't want in the stock market, I'm putting it in this ETF over here because I don't want to feel that fluctuation. I don't want to see it one day go up 5% and then the next day go down 4%, and then I'd rather sleep well at night knowing that I have my money parked here in case I need it for whatever reason. And unfortunately, I haven't found the equivalent for US dollars, so all my US cash is just sitting there as cash, whereas anything I have in Canadian is in this ETF. And don't be afraid, guys, of the 1 day or the 5 day chart. It is a little bit more volatile in the very, very short term, but if you go to a month or 6 months, you see that it is gaining over time. At the end of the day, it just comes to risk reward. The risk with this is very, very minimal, and the reward is better than any savings account you'll get out there. With a savings account, there is no risk, but your reward is 0.5%, which is pretty much nothing. Like any ETF, which stands for Exchange Traded Fund, ZST-L also trades on the Toronto Stock Exchange, meaning you would need to set up your own self-directed investing account. And in my opinion, just like I was talking about in my yesterday's video, is with Wealthsimple Trade, because since it's trading on the TSX, on Toronto Stock Exchange, in Canadian dollars, that means you can buy commission free with Wealthsimple Trade, which is way better than paying $10 a trade. Why would you if you can get it for free? Alright guys, that's pretty much it for the video. It is a boring bond ETF, but that doesn't mean it isn't useful in its own way. And remember, with managing your own finances, you should do everything purposefully. And if you see ZST.L fitting your goals, then take a look into it, do some research, see if it actually would fit what you want to do. Again, that's what I'm doing. And again, just because I'm doing it, don't do it as well. Do your own research. Otherwise, if you've watched this video in its entirety, thank you very, very much. Again, I think I've passed 50 subscribers now, so pretty awesome. Again, if you haven't already, please subscribe now, like the video, and drop me a comment, guys. Let me know if ZST.L fits your goals. Otherwise, thank you very much again, and I'll see you guys in the next video.